Gilles Moec, co-chief European economist at Deutsche Bank, with me now to answer some of those questions. And Gilles, I think you were saying the important thing to remember with this deal, yes, it is a step in the right direction. Progress has been made, but we're still very thin on details.
Yeah, tremendous progress has been made, but you're right, we need to flesh out a little bit all those statements from Thursday, because the impression was that the Europeans scrambled to come to some sort of announcement on Thursday night, but there's a lot they need to tell us. For instance, on this new power of intervention for the EFSF. First of all, there is a need for parliamentary approval. We knew about this, but they still need to tell us more about the conditionality, for instance, of this help. In the first version of the statement, there was strict conditionality mentioned about this. So we need to hear really about the mechanics of this intervention. Second, on the private sector participation, we have offers, we have a number of fairly precise things that have been put forward, but we still need to learn about the timing of all this. To me, definitely the momentum is good. But the need, for instance, probably to organize some kind of an ad hoc Eurogroup or ECOFIN meeting somewhere in the summer to allow us to have a better picture of all this.
A lot of economists and analysts we've been speaking to, for example, Willem Bouter, I spoke to him at the end of last week, and he said, yes, it's great that you have an expansion of the size and the scope of the EFSF, but they didn't actually increase its firepower. So, I mean, is there much point in expanding the remit if you know, the amount of money in the pot is still the same?
I think there's a little bit of confusion there, because on the size of the EFSF, it has actually been expanded in June. There was already a European summit in June, where the AAA countries, for instance, agreed to increase quite tremendously the participation by 70%, so that we've got a firing power which is actually much bigger now than it was before June.
Enough to help Italy and Spain?
Sorry?
Enough to help Italy and Spain?
No, not enough to help Italy. Enough to help Spain, enough to help Belgium, if, for instance, Belgium was to go into difficulties. But in a sense, no one can actually deal with public debt of the size of Italy with this kind of financial austerity mechanism, because then you would get into counterproductive territory. If we expand the size of the FSF to the point where it can cover the 1.8 trillion euros worth of Italian bonds, Italian debt, then you would get into issues about the AAA status of some of the countries guaranteeing the whole scheme. So about Italy, we've always said the same thing. Italy, first of all, depends on Italians themselves. They have to do the right thing, and they've already started. And if things were to turn absolutely sour, then the only thing that could actually stop Italy from getting into a complete mess would be central bank intervention. In this kind of situation, you need an infinite amount of money to deal with this sort of issues. But again, what they want to do, I think, goes really in the right direction, and there's enough money to deal with banks.
So there is. So then I'm curious, how difficult, how straightforward, how smooth would it be for the EFSF to step in and recapitalize weaker banks and also help out sovereigns that haven't been bailed out? Is there a bureaucracy? Is there some sort of approval framework that would slow things down, you know, that in a desperate situation it wouldn't work well?
This is what they need to tell us now. I mean, we have the principles. We know that there is a political agreement to do that. We don't know how it would actually be organized. The logic would be that the FSF would actually lend money to the states so that the states themselves recapitalize the banks. It's the easier way to do it. But there will be a need for conditionality. The Europeans are not just going to lend money without any conditions. So yes, there could be some sort of a bureaucratic process here.
Yeah, and interesting that you say, you know, it's been expanded, the FSF, but not enough to help out a country of Italy's size, and that even if it was, well, that would endanger the stronger countries that are guaranteeing a country like Italy. So I guess much of this will depend on a contagion being stemmed, essentially. Are Italy and Spain any safer in the markets now than they were a few weeks ago? Okay,
if you take Spain, the big Spanish issue is really the banks, because fiscal policy, of course, is a concern, but the level of public debt in Spain was never really the issue. It has actually one of the lowest debt levels in Europe. It was all about banks, and the issue for them was to be able to recapitalize the banks at a time when market conditions were just horrid. Now we have the certainty that if Spain cannot recapitalize its banks on its own strength, there will be a backstop from the EFSF at some point later on this year. And this is definitely what they need. And they don't need that money now, because the Spanish process is to wait until the end of September, come up with a figure of what actually has to be poured into the banks, and then the recapitalization vehicle, the FROB, will issue in October, November, December. So what matters for Spain is whether or not we have technically this backstop enforceable, let's say in October, and we should be able to be there. Italy, it's different. Italy doesn't have this kind of massive issue looming just right now that you can easily pinpoint.
I'm just thinking about the attacks that we saw in the bond markets, that the sell-off that we saw and the sudden rise in yields. I'm just wondering if, as a result of this plan, those countries are any safer from those sort of speculative attacks.
I think they are, because actually this brings us back to the good old times of the 1990s and the ERM interventions. As you know, last week or 2 weeks before, the market was extremely thin. I mean, it didn't take a lot of volume, actually, to destabilize the Italian market. And it's exactly the kind of situation where even fairly small intervention can actually have a quite significant impact in the market. Because 2 weeks ago, really, it was a one-way bet. Okay, if you attacked Italy, there was nothing really in front that would give you a sense of risk. Engineering short squeezes is what intervention ultimately does, and this is what is now being organized with the EFSF. But again, it can't be done just now. They still have to go throughout the parliamentary approvals and so forth. So this is not here at the moment available. If things were to turn sour, again, the only option would be ECB intervention.
Yeah, and we're eagerly awaiting the specifics on the plan that we had last week as well. Gilles Moec, co-chief European economist, Deutsche Bank, great to talk to you. Thank you so much.